ton of banking crises in my life. The outcome is always the same 100% of the time. Emergency rate cuts as fast as you can. Now, we're not there yet, but once we get the next leg lower in these banks, they didn't close well today, and the bond yields, 10 years closed on its lows. Once we see the next leg of that, which is why I've got the buy bonds, wear diamonds t-shirt, because the only thing you do in a situation like this is buy bonds. Once it makes the next leg lower, that's going to set the alarms off. We've got to get through the Fed meeting. I also, which is very controversial, I'm very bullish equities because more cowbell. If you debase the currency, equities go up. So I'm very bullish crypto, very bullish bonds, very bullish technology stocks in particular.
Doomsday predictions are becoming more frequent as the banking crisis plays out. Despite all the criticism, economist Raoul sees the developments favorably. He claims that despite many on FinTwit calling for it, a 2008 redux is impossible. Asset prices fell so drastically in 2008 that a collateral spiral developed. After the introduction of quantitative easing, it took 6 months for the value of the collateral to stabilize and debt levels to drop. In spite of all the bad news, economist Raoul sees the situation in a positive light.
They have to steepen the yield curve as fast as possible, so I think they cut rates 200 or 300 basis points in pretty short order. So I'm talking into late summer, September or so. We will go into recession. Andreas and I have been flagging this forever. It was, in our forward-looking indicators for a long time. We go into recession. My guess is we come out the other side, i.e. we hit bottom maybe this quarter or next quarter. And then we come up the other side. The other side's going to be slow. Trend rate of GDP is slow, and it's going to be ugly and messy. But right here and right now, this banking crisis is not going to go away. And certainly by lending a bunch of big banks money and putting it onto other people's balance sheets, none of this shit's going to work. It just smells. The whole thing smells. And it's going to have to unravel in the age-old way, which is everyone's going to start panicking about the insolvencies in these firms, whether it's deposit flights or their books. And in the end, the Fed has to come with a cowbell.
Some of these banks lending money at the Fed now go bankrupt, then this will turn into QE automatically. And that is probably the end game here anyway. So whether we call it QE or not, it doesn't really matter a whole lot. If you look at the move in the 2-year bond yield just this week, then try and compare it to the move in the 2-year bond yield after Lehman or after 9/11. The moves that we saw after 9/11 and the Lehman, they look like a drop in the ocean compared to what we've seen over the past week here. So the bond market is screaming, and you should never bet against the bond market screaming this loud. I need to emphasize that. So I agree on the direction of travel with Raoul here.
If your collateral is going down, you go bust. But what QE does is make your collateral go up optically in price. And so it stops the bankruptcies. Doesn't mean you repair the P&Ls or anything else, but if your collateral doesn't fall, you're okay. So I don't think it can ever get as bad as 2008 using this particular mechanism. There's an outside chance for sure. I don't think so. I don't know. Andreas, what do you think?
The Fed did last Sunday was essentially to backstop the US Treasury market with this new lending program. They've been telling banks since 2008 that the US Treasury market is the safest in the world, and therefore they need to back it up. They've been telling banks to hold treasuries in their high-quality liquid asset portfolios. It's simply regulation. They need to hold these assets, and therefore the Fed needed to step in to ensure that the Treasury market functioned. So in that sense, it kind of resembles what happened in the UK during the autumn last year, that the central bank simply had to step in to backstop the core functioning of the yield curve and the core functioning of the Treasury market locally. And therefore, I perfectly agree with you, Raoul, that since the Fed has now backstopped the US Treasury market, it will not turn into a collateral crisis. What it will turn into is a major move of deposits from small and medium-sized banks to a very few large banks. So we will end up with a US banking system that will look a lot like the European banking system after this crisis is over. And I can guarantee you, by watching the price action in European banks and after having worked for one of the biggest Northern European banks, that it is not a bullish scenario for US large caps.
So economic growth, we're going into recession. I think it's more like 1990 recession, which was pretty nasty. It didn't, the stock market fell 20% that time. Bond yields collapsed. The banking system was creaking at the seams. Commercial real estate took 4 years to recover. Jobs took a long time to recover. I think that's what we're doing. But I think it's, again, a lot of people are looking at 2008 or 2000 saying it's going to be something like this. I don't think it is. I think it's a traditional recession with credit contraction that creates an overhang in some parts of the economy. So I think we go down fast, take a long time to recover, because commercial real estate is stuck on all of these small banks' books. And I was sitting down with the commercial real estate portfolio manager of one of the biggest pension funds in the United States 3 days ago. And he's like, some of this stuff is never going to get used and never going to be sold. They're going to literally have to bulldozer it down. He said it's already seeing it in many cities in the US, is that people just aren't going back to work. Look at Real Vision. Maggie, when's the last time you went to the office in New York? We're stuck in a lease. We reduced it from 65 people to a 35-person lease, and still 2 or 3 people go to the office. Even here in Cayman, it's only a 5-minute journey for us. There's 2 people in the office. No, it's finished. They're stuck. And those losses are going to have to get eaten by the pension system because they own it. I mean, I've been calling for the oil to get to $60, and I think I might be optimistic. Let's see. Now, we all understand the supply shortages, but demand wins every time. Everyone forgets this. The great conversation with, as ever, Dwight Anderson, who's like the world's best commodity hedge fund manager. And he's like, yeah, I'm bullish on oil on a structural supply story, but you got to factor in demand. And in a recession, nobody uses oil. We've got stuff like excess inventories everywhere. So that means industrial production slows down. And if there's excess inventories, then industrial production in Asia slows down as well. So there's going to be less demand for oil. I mean, all of the commodity prices now en masse are down year on year. They're negative. So that's deflation. There is, I do not see a single shred of evidence to suggest that inflation is sticky. I think it's a false narrative, and it's going to get taken out and shot over this next few months.
As the U.S. central bank raises interest rates, things start to go wrong more often in the financial system. This leads to a crisis. Since SWIFT closed Silicon Valley Bank and Signature Bank last week, there has been a lot of stress on U.S. regional banks. Raoul Pal thinks that Powell and the company will decide to raise rates by 25 basis points at the next meeting and send a message that more rate increases are on hold for now. Considering how bad things are in the global financial system, that would end the Fed's year-long cycle of raising interest rates. What do you think of Raoul Pal's point of view? How much do you think the rates would go up? What do you think? Tell us in the section below. Make sure to click like and subscribe and turn on notification bell to see new videos. Thanks for coming to watch.